Well, hot on the heels of a stunning 2024 price performance, the big question is, with rising global complexity and geopolitical risk, plus, of course, Trump 2.0, is this year more difficult than most to predict the path for gold? Well, I put that question to John Reade from the World Gold Council. Here's what he had to say to that.
I think that's a very good summary. Normally, we have a pretty good idea what the political landscape is going to look like in the coming year. And you can make some fairly decent predictions about what interest rates are going to do. This year, I'm afraid, all bets are off. With the new administration in the United States coming out with pronouncements on a daily basis, and with the potential influences that that might have on the US economy, it's really hard to work out what's going to happen this year, from everything from tariffs to inflation to growth to interest rates to immigration, deportation, etc. And all those factors could play a big role in how gold turns out this year.
Yeah. So because we don't have a crystal ball in that regard, why don't we just stick with some of the fundamentals for our audience? Why should investors still consider gold as a fundamental part of their portfolio?
Look, I think gold's role in a portfolio is very straightforward. It's a combination of returns, portfolio diversification that works when you really need it, liquidity. Those factors really are the key things behind gold's role in a portfolio. Now, people think gold does well during periods of high inflation or crises, and that's generally true. But it also does well over the long term as well. If you look at its performance on a 20-year basis, it's produced returns that have been in line with or better than other asset classes. If you look over the last 3 years, it's been the best performing asset class. If you look over the last year, it delivered in US dollars about 25%. So it's a source of returns for portfolios. But probably more importantly, it's actually a diversifier as well. So if you look at gold's correlation of returns with other asset classes, there's no particular long-standing correlation at all with equities. But if you look at what happens when equities fall sharply, gold's correlation goes negative. In other words, you're negatively correlated to a falling asset, and that's really useful in terms of portfolio performance. Another way of thinking about it is that it offers some crash protection to a portfolio, so that when everything else is going to hell in a handcart, the gold component in there actually helps you somewhat.
Yep. So it's a strategic asset. Go ahead.
Yeah, I think that's right. I mean, tactically, as you say, no crystal ball in sight. Who knows what's going to happen in the next 1 month, 3 months, 6 months? But over the long term, it has been a valuable component of portfolios on a strategic level.
Now, John, you alluded to the fact that gold had an outsized performance last year, particularly for Australian dollar investors, without seeking any price projections because it's just too difficult. Do you reckon that gold will supercharge portfolios in 2025, as did happen last year?
Look, gold produced in US dollar terms about 25% in 2024. And about 15% in 2023. Investors should not expect that kind of performance each year. Work that we've looked at from a fundamental perspective indicates that gold should give you something like US inflation plus 2 to 3% each year on average over the long term. Now, that doesn't sound particularly impressive compared to the returns we've seen over the last couple of years. But that, in combination with its diversification properties, make gold a really valuable asset.
John, I don't want to get too far into Trump 2.0 because we could talk about it, for many different angles. But one that has come to the fore repeatedly is that his crypto-friendly, tech-friendly agenda, particularly when it comes to crypto, will be some sort of a competing factor to holding gold in a portfolio. What is your view of the impact of Trump and his crypto-friendly policies this year?
Well, I'm unsure what he'll do in the crypto space, but I think you're absolutely right in framing him and his administration as more crypto-friendly than we've seen before. But I don't know what that means for crypto assets. Assuming that it's good news for them, and my Trump crystal ball works worse than probably any other crystal ball that I have. But assuming that it does work well for the crypto space, it certainly doesn't threaten gold. I think the people who invest in crypto are looking for very different things from their crypto investments than they are from gold. Investors hope to get rich in crypto, whereas people who hold gold, particularly who hold gold as a strategic asset, are looking to help protect their portfolio. If you look at the correlations, the returns, they're really very different assets and in many respects complementary. One of the things we say to people is that if you've made the decision to add crypto to your portfolio, understand you've added a lot of risk. And if you've added a lot of risk to your portfolio, then you need to diversify that portfolio even more. And gold is one of the best diversifiers out there. So I don't feel threatened by the Trump administration's friendliness towards the crypto landscape.
Interesting. Yeah, it's almost that hedge, again, that safety hedge in unknown times. All right. One criticism that I think many in our audience would have heard or potentially be thinking themselves, what about income? You know, you don't get income from holding gold.
You don't. You don't get income from holding assets which don't have credit risk. That's one simple way to think about it. Gold can do an awful lot for your portfolio, but it doesn't give you income. But the returns that it gives, the diversification benefits, the crash protection benefits that it adds to a portfolio outweighs those. And I think that's why investors should think about portfolios. The different asset classes that they own are expected to perform in different ways. You can't just buy stuff because you think it's going to go up. You've got to put together a portfolio which is properly diversified. I mean, it is famously, diversification is the only free lunch in investing.
So that was John Reade joining us from the World Gold Council. And to expand out this high conviction idea, we will also be speaking with Joe Cavatoni, who's joining us from New York, or Washington, I should say, from the World Gold Council, and from an investment perspective as well. We've got Shawn Hickman joining us in studio from Market Matters. Gentlemen, welcome to you both, and feel free to tic-tac off one another as well. But Joe, I'll start with you. I asked your colleague, John, whether, it's a pretty tough one to try to predict exactly what the drivers of gold will be this year because of, the complex not only geopolitical environment, but also rates environment right now too.
Yeah, I think that's right. I think what we're going to be expecting for 2025, like many people who are trying to read the crystal ball of the political landscape that's coming out of the U.S., that measured over with the overall impact that it's going to have on the U.S. economy and Fed and the monetary policy, it's leaving us in a range where we're looking and feeling like we're going to be more range bound. We're excited to see that year to date we're up just about 4.5% on the gold market in dollar terms. But I think more importantly, the big driver of the Western investor and the investor sentiment to add gold to their portfolio, expand the role it's playing in their portfolio, needs to see more clear signals and more information as to what and how these economic policies are going to develop and exactly what that portfolio allocation could look like. With that, I'd say, though, the big case that we've had for a large area of consumption for 2024, 23, and 22, which has been the central banking community, in particular emerging market central banks, that case remains strong. This is a catalyst and an area of demand in the market that's going to keep that gold market strong over the course of 2025. We see that demand still very high. But again, in the Western investor sentiment, I think that there needs to be clarity in the landscape before we see big moves in their demand profile. Okay,
Shawn, how does that jive with what your expectations are for gold?
Pretty close. I think gold is going to be in a buy the dip frame of mind this year. It's going to be well supported by the central bank buying. But I think we've lost, or we are in the process of losing, the obvious tailwind of the last 2 years, which is the Fed cutting rates. And my view is we are going to see a year of consolidation with an upward bias for gold, especially against the Australian dollar, which is another subject. But, I can see gold hitting $3,000 this year, but I'd be more of a seller up there than a buyer. It often pulls back 10, 20%. It's nothing unusual. It does it most years. When it does that, I'd be a buyer. So I think it's going to be quite an interesting scenario. The Trump backdrop, as you said, geopolitical, he's just doing what he said he was going to do in a very volatile manner. And there'll be plenty of times where people think, oh, gold's a bit hot. It was as hot as AI was last year, and we saw what happened to that last week. Last year or the year before, lithium was hot. We saw what happened to that last year. So I think we are going to see some pullbacks in gold this year at times. I don't think it will be the runaway train we've seen over the last 2 years, and that by definition will create with it opportunities. But we still like gold, and we're going to have to be forced out of our gold positions before we start taking profit.
Yeah, all right. So happy to hold gold. Joe, when it comes to the view on rates, that's a complicated one, but it became maybe a little bit less certain here yesterday with the quarterly inflation read that came through. Now we've got some calls for an RBA rate cut coming through in February, but regardless, rates will be coming down eventually. When we talk about gold in Aussie dollar context, I mean, what are the assumptions being made by the World Gold Council then when it comes to the Aussie dollar, should it remain under pressure, and what that will mean for gold within Aussie portfolios?
Well, I think the expectation is, yes, that the rate environment will definitely show that declining trajectory that we've been talking about. And I think in particular with the Aussie dollar, we think that it's still going to remain under pressure. All of those factors, in our opinion, is going to actually continue to be a strong case for the diversification into an asset that will hold its value against the depreciating Aussie dollar, and that would be gold. I think, again, we're looking at gold as a component of a portfolio. I think in a world where you're seeing the Aussie dollar under pressure, the diversification to the gold market will actually increase your ability to manage that risk. And I think overall, the rate environment coming down is going to actually be a much more favorable environment. I think with the Aussie dollar and the Aussie rate market under pressure coming off, I think that that's important. But I also think that there's going to be a lot of eyes and a lot of attention paid to some of the bigger markets in terms of the rate direction. And I think the U.S. in particular is probably the market that we're going to see having more of an impact in terms of a move on the gold price than maybe some of the other markets on a global scale. So I think the hold from the Fed today has actually been something that might continue to put us in terms of a trajectory, a little bit more of that holding pattern that my colleague has talked to in terms of the price performance of gold.
Exactly, and that's what we're saying. I think we're going to see Australian gold stocks outperform their US counterparts. Gold will probably keep going up. I can see gold trading between 4,000 and 5,000 Aussie, but a lot of that support will come from a weak Australian dollar. But we also should remember that markets look ahead. The Australian dollar is down 10% over recent months, so it's already factoring in the Australian dollar or the RBA cutting more than the Fed over the next 12 months. That's already in the market to a certain degree. And the Fed once or twice this year, probably twice this year, is what the market's now looking for. I wouldn't be surprised them back off from that. And that will see gold slow down. But it's interesting. I think gold fell $35 last night. This morning, Australian gold stocks are up again. The momentum is still strong. Don't fight the tape, as the saying goes. So locally, gold stocks still look okay. But in the bigger picture, gold in US dollar terms, it looks like it needs a rest. And I totally agree with our friend.
Yeah, okay. Well, Joe, talk to us a little bit more. I think that our viewers would want to, have it fleshed out a little bit more, whether in a portfolio it's a strategic asset now and likely through 2025 for growth or for defensiveness, or can it do both?
It does both for sure. And I know that's a great, simple answer to give you, but let me unpack it a little bit more for you. On the short term, and I think the thing we haven't talked to is that we're probably going to see more volatility in the gold price. We've already seen it. And I think while being range bound and kind of flatlining until we get more clarity, that volatility level and that dip that you talked to is actually an important point to highlight for people. But range bound. And actually, it's moments like this when we don't have clear direction around the long-term strategic growth from economic expansion or that price pressure upward on the gold market, that we know that it'll play a key role in the defensive scenario. So if you look at the drawdown history of gold or gold's performance during drawdown moments, you're going to find that it actually does exactly what you need it to do. I think that's what's keeping gold held at those steady levels in Western portfolios, that hasn't been really sold off as much as maybe we had expected it would have during a strong dollar, a high rate environment, an alternative to the gold investment environment that you would have seen in the Western markets. Ultimately, you've seen those assets being held and the allocations to gold on the dollar terms staying steady in the Western portfolios. And it's simply because of that. On the shorter term, It's going to be that shock absorber that it plays in your portfolio, that ballast that it helps you when you have drawdowns and risk moments of sell-off. I think we need more clarity before you can start to see allocations and the growth story come to play.
Okay. Shawn, then again, we talk about it from an investor's perspective. Is there a rule of thumb for how much should be allocated to gold, whether that be physical gold or, in your case, gold stocks?
No. It all depends on whether we think gold is going up and the gold sector is going to go up. I mean, let's be realistic. Over the last 3 years, a lot of the gold stocks have had a shocking time. You know, you look at Newmont, it's a lot lower than it was 3 years ago. So you've got to be looking at gold stocks that are doing the right thing. They've got a low all-in sustaining cost. I mean, the one that comes to mind for us, our favourite stock is Evolution or Evolution, depending on how you like to pronounce it. With gold trading around 4,500 Australian dollars, all-in sustaining cost of 1,500 dollars Australian. It looks great. Record cash production last week. Solid, really, really doing well. Growth story, etc., etc. You've got to pick the quality stocks that are making good money at these prices. Otherwise, they probably never will.
So that's Evolution.
Yes.
And just expanding on your point about Aussie gold miners outperforming those that may be operating in the United States, we've got the interesting case of Newmont listed here.
Well, we haven't held it. We're very proud that we've avoided it for a long time. It keeps looking tempting and then it lets you down again. So it needs to start performing operationally. I mentioned that corny phrase before, don't fight the tape. That's very true at the moment. Just stick with the quality, stick with the stocks that are doing the right thing. Sure, you'll miss a few months or a quarter where some of the underperformers will play some dramatic catch up. But I don't feel like we need to go venturing off in there and have some sleepless nights. Stay with the quality, stay with the stocks that are really, really turned the corner. Don't forget, it wasn't that long ago that Evolution went out and increased their gold exposure. They bought gold assets at low prices, and they're starting to pay dividends now.
Yeah. Okay. Joe, I'd like to just maybe pick your brain about what's happening in the ETF market and what flows into those physically backed gold ETFs could be telling us about momentum into 2025.
Well, I think there's actually some really interesting stories that are already starting to develop. I think what we've seen from the Western investor community, a concentration of a bit of redemption in the U.S. market, so a little bit of flows out from the U.S. But the big story right now is actually what we've been seeing and what we've been kind of perplexed by, which is when will the European investor step back into the market? And year to date, they're in for just over about 2 to 2.5 billion. And on the Asian and Australian front, I think that the market remains very healthy. 2024 was a strong year for the market for ETFs in that part of the world, but the early part of the year looks a bit mixed in terms of what we're seeing in terms of overall flows. It's a good corner of the market to look to and actually see what's developing. But remember, as a global market, the ETF market is about 6 to 7% of overall investment. So it's important to watch it. It's key to see what's happening. It does give you some transparency into what's playing out. But the overall OTC market and the physical market for gold investment is actually the biggest component that we're keeping a close watch on as well. That in the Asian region has been strong, and I think that we'll see how that develops into first quarter. But right now, again, the ETF market really a standout right now is showing us that the European investor, the UK, Germany, Switzerland, all coming back to the market and putting money back into the investment landscape.
All right, Shawn, now that we have you here, we are getting some questions in from our audience, and this one is coming from Stuart. Came in actually ahead of time today, saying silver has historically followed gold. Talking about not a lot of opportunity here in the ASX market other than perhaps Adriatic. So he's saying, should I look to the US, small, mid, or large cap, or all three? Do you have a view on silver?
Not a strong one, to be honest with you, because it has got limited opportunities here. It's not a commodity we follow that closely. So if I had a strong view that I thought silver was going to follow gold, I would go with a simple physical silver ETF.
Okay, got it.
Keep it simple.
And so, Joe, just to wrap it up, when you are thinking about, the 4.4% appreciation in the gold price year to date, perhaps not taking into account last night, in Aussie dollar terms, you've got to say that you're pretty positive going forward, optimistic?
We definitely have a favorable view on the role that it's going to play simply because of the understanding that we have of the use cases that are out there and the case that each of them have for being uh, interested, if not actively engaged in the gold market. Starting with the central banking community, particularly on the emerging market front, continues to be strong and very interested in adding to their reserve portfolios on a global basis, not only for the reasons of homegrown concerns around their economies, but also geopolitical tensions, et cetera, that continue to put that front and center. I think the emergence in 2024 of global investment demand, whether it was in the Eastern markets that drove the sentiment in the first half of the year, married with the second half of the year driven by Western investor, it's all eyes on gold in terms of when you can come back to the market and increase allocations to gold. I think the one area that we're kind of keeping a very close watch on is the jewelry market. In times when gold prices get to higher levels, in particular 2,700 in dollar terms, this is when you start to see the consumer, the real true consumer on the jewelry side, step a little bit back from the market. They need to let that price settle in and sink in, and then ultimately come back with their demand over time. So in China and India, we've seen that slow a bit, but that's probably the one spot where we've been quite interested to see how the demand develops. But again, on the investment side, whether it's from central banking communities or from the investment on a global scale, we see the case remaining strong. Hold it for risk diversification short term, and strategically, when do you come back to the game with the increased interest and rate environments lowering?
And just to reiterate, Shawn, your high conviction pick, Evolution Mining, but you will not be pushed out of your gold holdings.
No, absolutely not. I think it's going to be a fairly choppy, volatile year. I can see gold being up and down 10% from where it is today. And by definition, our strongest conviction is to buy the dip. For example, if we had a solution coming out in Ukraine, Russia, that might seem a bit of relief, bit of geopolitical risk, send gold down for a few months. That to us would be a buying opportunity rather than a panic get out opportunity. It would have to really blow off on the upside, maybe through 3,000 US, for us to consider taking some profit. Not getting out, taking some profit.